Hi, I'm Jim and I was retired. Are you worried about inflation eroding your retirement savings? We got the latest inflation numbers this morning, and while they weren't terrible, consumers and economists worry that higher inflation is coming back later in the year. Now, whether you are a DIY retiree like me or still accumulating for your retirement in the near future, let's look at the best ways to protect your savings in 2025. In this video, I'll show you how we protect our DIY retirement portfolio with an ETF bond fund like Vanguard's VTIP, as well as individual tips in our IRAs. And I'll discuss how tips compare with the Series I savings bonds that we hold in TreasuryDirect. Stay tuned while I'll review the best inflation protection for 2025, VTIP, TIPS, or I bonds. Now, inflation has come down from its 40-year high back in 2022. Earlier this month, the Bureau of Labor Statistics reported the Consumer Price Index, or CPI, for May, and it came in at 2.4% higher than a year ago. This morning, we received the Fed's favorite measure of inflation, the Personal Consumption Expenditures, or PCE index, which came in at 2.3% year over year for May. But what happens if we see inflation move up again? As I discussed in a recent video, the break-even measure between nominal treasuries and Treasury Inflation-Protected Securities, or TIPS, tells us where the market thinks inflation will be over the next 5 to 10 years. Could we see a return to 2022 or worse, the 1970s great inflation? Now, the TIPS bond break-even rate looks at the difference between the yield of a nominal treasury note and the real yield of its corresponding TIPS offering. For instance, the daily reading of the 5-year break-even is currently at 2.29%, down slightly from the monthly average for May that I'm showing on this chart of 2.4%. This is the measure that reflects the market's expectation for average inflation over the next 5 years. That's the main reason we've added inflation protection to our retirement savings, and why you may want to do so for your retirement savings. Inflation protection is especially important if you are 5 to 10 years away from an expected retirement or in retirement like me. Retirees need inflation protection to preserve their purchasing power, especially for those essential expenses. Now, since the 5 and 10-year break-evens are in line with these current readings, I'm not sure I would bet all the chips on inflation-protected securities, especially since nominal treasuries are earning real rates right now, rates in excess of inflation. For instance, on Wednesday, the Fed captures the market data for market rates for the 5-year Treasury notes, and that was at 3.83%. And the corresponding 5-year TIPS on Wednesday was a real rate of 1.55%. Now, financial advisors often recommend allocating 10 to 50% of your bond portfolio to TIPS. That translates to between 4 to 20% of a total 60-40 portfolio. And this balances inflation protection with diversification and income needs. Conservative retirees might want to allocate 30 to 50% of their bond portfolio, which is 12 to 20% of the total portfolio, to TIPS. Moderate retirees might want to target 20 to 30% of their bond portfolio, when that corresponds to 8 to 12% of the total portfolio to TIPS. Now, I'm more in this camp, as I'll get to in a minute. Now, if you have many years to go before retirement, or if you're an aggressive investor in retirement, you might rely on growth in stocks and nominal bonds for diversification. Equity is the best long-term hedge against inflation. Since principal adjustments to TIPS, as I'll get to in a minute, are taxed annually, even if you continue to hold it, It's best to hold them in a tax-deferred account like an IRA rather than taxable brokerage accounts. But let's go over the inflation protection options. Let's start with the TIPS. They have TIPS available in 5, 10, and 30-year terms. I generally look at 5-year right now. I have some 10. If you're in your career, you might look at 30-year terms for TIPS. Now, the principal of a TIP will go up and down based on CPI. Now, the TIPS pay a fixed rate of interest that's set at auction every 6 months, but because the interest is paid on the adjusted principal, the amount of the payment varies. Now, when the TIPS mature, you get either the original principal or something higher than that back. You never get less than your original principal. You can hold TIPS to maturity or sell them on the secondary market. So here's some pros of owning TIPS. You're guaranteed the principal. Held to maturity, the TIPS will return your inflation-adjusted principal, ensuring real value protection. Now, that's unlike holding an ETF or a mutual fund, where what you get when you sell depends upon the NAV at that market day. Now, you get to control and customize the TIPS that you hold based on when you think you need the money. So you get to select maturities that match your needs. There are no ongoing fees after purchase. Individual TIPS are purchased through our brokerage accounts. And actually, at Schwab, I have no fees for purchasing treasuries or TIPS at auction. Now, that's unlike the mutual funds or ETFs, which will have ongoing expense ratios. Now, let's look at some cons of holding individual TIPS. It's a management effort of selecting which TIPS match the maturity that you need. That's a lot of work, and it does take some study. You can use some tools to navigate a TIPS ladder, but you need all the capital up front to do that. You do have liquidity risk. Individual TIPS are less liquid than the mutual funds or ETFs like VTIP. But you will have a price impact if you sell before maturity as well. And there's the diversification challenges. You've got to select enough diversification in years of maturity as opposed to just buying one and being done. Here's some pros and cons for using an ETF like VTIP for your TIPS. One purchase and you have 26 TIPS of varying maturities of 0 to 5 years and greater liquidity. VTIP trades like a stock and you can trade it throughout the market day. Unlike an individual TIPS that you hold that you trade on a secondary market, it really will depend upon who's buying that day. There are also low fees for VTIP. It has a 0.04% expense ratio, which is among the lowest in the category. There's an ease of management. You're buying one ETF, not individual TIPS. But there are some cons. The principal one is that there's no guarantee of your principal. When you go to sell a VTIP that you purchased, it really will depend upon the market price, the NAV of that ETF on any given day. You're not guaranteed that you're going to get your principal back. There are ongoing fees. Although they're low, you'll pay that expense ratio as long as you own the ETF. There's less control. Vanguard selects the TIPS that are in this ETF. You have no choice. Now, let's compare some pros and cons for I bonds. Number one, you have to use ordinary income to purchase them. And when you get them, you'll have tax-deferred ordinary income until redemption. But eventually, it'll be ordinary income. You do have semi-annual compounding. Right now, it's a 1.1% fixed rate plus the inflation factors. The full or partial redemptions after 1 year. a modest 3-month interest penalty through year 4, and no interest penalties after 5 years. And some cons for I bonds. Number one, you can't purchase them in a tax-deferred account. You have to use your taxable assets. And your annual purchases are limited to $10,000 per tax ID each calendar year. I got to strike this last bit. They took away the paper bonds, so you can no longer do that. You can only buy them digitally. And finally, there's no secondary market for I bonds. You have to redeem them at TreasuryDirect. Now, here's how inflation protection fits into our 3-bucket retirement portfolio. Bucket 1 holds enough cash for withdrawals to meet 3 years' worth of expenses, and I hold that in cash and equivalents, T-bills and shorter notes. Bucket 2 has the income-producing assets for the next 5 years of withdrawals, and I've designed it to beat inflation. And as you can see, this is where TIPS and I bonds fit into Bucket 2 assets. And Bucket 3 holds equity, which in the long run is the best way to hedge against inflation. Our overall asset allocation is currently around 60-38. It began the year at about 60-40, and I'm working slowly up, so I'm 70-30 by the time I turn 70 and start collecting Social Security. As this chart shows, inflation protection is currently 26.8% of our fixed income portion. That includes the VTIP and TIPS that we hold in our IRAs and the I bonds in our TreasuryDirect accounts. By the way, my sample portfolio by bucket spreadsheet that's available on my Google Sites includes these charts, including this one for maturity by year, which I use to plan our Treasury ladder. Go to the Google Sites and download a copy if you're interested. Now, while there is a way of purchasing TIPS ladders all at once with some neat tools out there, you need the capital up front to do that. I've been purchasing TIPS and nominals at auction. I've shown the TIPS holdings here in yellow on this chart, and we'll fill in 2031 and 2032 with TIPS, but I'll keep the overall TIPS holdings to about 25% of fixed income. So what is your preference? Do you use TIPS funds like VTIP or a mutual fund? Do you use individual TIPS or I bonds for your inflation protection? Comment below and let me know. And if you found this video helpful, please share, like, and subscribe for more DIY retirement tips. Now, as noted, I use a combination of all three. Now, I started using VTIP along with BND and BIV a few years ago when I switched from actively managed mutual funds to my own individual ETFs. But after the dismal 2022, when both equity and bond ETFs suffered market losses, I decided to move from bond funds to individual treasuries, CDs, and TIPS. Now, I may go back to bond ETF someday for ease, but right now I prefer to control what bonds I buy and hold for what maturities. I will also continue to hold I bonds in the TreasuryDirect, and I may add to those holdings with taxable assets in October once we know what the direction of rates will be. For now, there's a 1.1% fixed rate and a 3.98% composite rate for the first 6 months of any bond bought before the end of October. So when I look at it in October, I'll look at what the next inflation factor is likely to be on November 1st for the second 6 months of holding the bond. Hey, see my playlist on I bonds here if you're interested in the subject. The most recent additions for our inflation protection were purchased at the reopening of this 5-year TIPS earlier this month. And actually, we purchased this TIPS in April in its original auction and again in June in the reopening. The April's real yield to maturity for those TIPS was 1.705%. But this reopening got a reasonably good real yield of 1.65%. Now, I'll put a link to David Enna's write-up of the June auction and the details below. But note David's definition here of real yield to maturity. That's the yield above the official future U.S. inflation that you can expect over the next, in this case for June, the next 4 years, 10 months, if you hold it to maturity. And that's why it's a little higher than the current market yield, which would be what you would get if you sold it on the secondary market. Just this week, I read this article from Morningstar's Jeffrey Ptak, who said investors need to rethink how we're using TIPS funds. He notes that investors in intermediate and long-term TIPS funds withdrew their money before returns improved, and then added more later in 2024. We seem to be struggling with getting the timing down. He noted that investors have done slightly better job on short-term TIPS. Now, I've held my VTIP, but I don't want to add to it right now. I just don't trust the TIPS funds yet. And by the way, the shorter-term TIPS are better suited because I need the maturity in my bucket too. Now, he notes that investors might be better off constructing a bond ladder. For most investors, the inflation protection is the main draw. So the key is to ensure a way to stay put and obtain just that. Given that, he thinks a TIPS ladder can make sense. Now, the main obstacle in doing that is administrative. You've got to purchase your individual bonds, and unless you're letting the ladder run off like us retirees do, you need to replace the maturing bonds with new issues. And it's kind of a pain, he notes. And he added here that there are new ETFs with target maturity simplicity, like iShares I Bonds 1 to 5 TIPS ladder with an ETF of LDRI, and LifeX 2055 Inflation Protection Longevity Income, LIAM. Notes and concludes here, is laddering in this fashion optimal? No, but it seems far less suboptimal than the way investors seem to be using TIPS funds. And I'll put a link to Jeffrey's article below as well. I will conclude with my standard warning. I'm not an economist or a financial planner. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out professional help if you need it.